Good afternoon. Thank you all for participating in today's Corporate Compliance Institute webinar entitled Financial Relationships, Laws, and Regulations for FQHCs, presented by Clay J. Countryman, partner at Brazil, Sachs & Wilson, and Mr. John McDaniel, founder and chairman of the LPCA's Corporate Compliance Partner, Peak Performance Physicians. All lines will be kept on mute during the training, but feel free to type any questions into the question box. If you would like to ask your question verbally toward the end of the hour, please raise your hand on the screen and we will open your line at the appropriate time. If you are going to utilize this feature, please make sure you have entered your audio PIN. Today's handout slides can be downloaded at this time from the handout section of the webinar, and the recording of today's session, as well as those presented in previous sessions, can be found on the LPCA website by Member Health Centers under the Member Login tab and LPCA Webinars and Technical Assistance page. Mr. Countryman and Mr. McDaniel, thank you for offering this course today, and I will now turn the presentation over to you.
Hello, good afternoon. This is Clay Countryman, and I'm with my co-panelist or speaker, John McDaniel. We're going to go through the slides and have a discussion for the next 45 minutes to an hour, focused on financial relationships and laws and regulations that affect the business and ongoing operations of FQHCs. I'm going to try and follow along with the slides. We may make different points at different times. Feel free to type in questions and we will address those at the end of the webinar. So that on the first slide, we've summarized the focus of our presentation, which is to address the various fraud and abuse laws that we believe are most applicable to financial relationships of FQHCs in regard to relationships with physicians and other healthcare providers. We're also going to discuss different ways to identify financial relationships and compliance risk areas that we believe you should focus on through your compliance initiatives and practices. And really, we're going to talk about what are the hot areas that we've seen within the last 1 to 2 or really 3 years that have been focused on by different enforcement agencies and have the most potential liability for the operation of FQHCs. And then finally, we're going to talk about a few lessons learned from practical experience, recent settlements and cases, as well as make some recommendations for your ongoing compliance operations. On the third slide, we've listed the fraud and abuse laws that we're going to focus on in the next 45 minutes to an hour. There's several fraud and abuse laws which can apply to your operations, and that would probably be a whole week course. So we decided to give kind of somewhat of a high-level discussion on these particular statutes and break them down into specific examples with each of those. The slides just go into our discussion on the federal anti-kickback statute, the physician self-referral law, or otherwise commonly known as the Stark Law, after Pete Stark, of Congressman of California, the Federal False Claims Act, and then also going to talk about the Civil Monetary Penalties Law, and we've listed on this slide the Louisiana Anti-Kickback Law. Now, I just want to mention on the Civil Monetary Penalties Law, that is the section of federal regulations under which the Office of Inspector General, or the OIG, may seek to impose civil monetary penalties on an individual or organization for different types of conduct that's prohibited under the Civil Monetary Penalties Law. For example, filing false or fraudulent claims for medically unnecessary procedures. And what's important for the webinar today is there are kickback provisions and self-referral provisions within the Civil Monetary Penalties Law. So you may violate the self-referral provisions or prohibitions within the civil monetary penalties law, as well as the Stark law, but a healthcare provider may end up paying a civil monetary penalty fine as a resolution in that type of situation under the civil monetary penalties law instead of under the physician self-referral law. Just wanted to give that example because you'll see or read about cases and settlements where there's allegations that a healthcare provider had violated the federal anti-kickback statute or the Stark law, but the government took the position that those claims were false claims and violated the False Claims Act. However, they ended up settling for payment of civil monetary penalties under the civil monetary penalties law. And if you want to read more about it and see examples, I recommend you look at the Office of the Inspector General's or OIG's website, and under their compliance section, it talks about recent enforcement actions, and they list several ongoing settlements under the civil monetary penalties law, and it gives you an idea for the types of conduct and actions that resulted in a payment of a civil monetary penalty by a provider. Now, at this point, you should be getting pretty excited about that information, so I'll just mention the last statute on this slide, the Louisiana anti-kickback law. That is, in Louisiana, it's a statutory prohibition against paying anything for a referral, paying or offering or soliciting any type of remuneration, either to make a referral or receive a referral from another provider or anyone. And what's important to know about this statute is that it applies to any kind of patient situation, regardless of the payer of the services. So it can be a federal payer, Medicare, Medicaid, or it can be a commercial health insurance payer, or it could be workers' compensation or any type of payer situation that could violate the anti-kickback law. This law is also specifically targets licensed professionals or licensed healthcare providers in Louisiana and is enforced by the particular licensing boards for each type of provider. For example, physicians who are licensed by the Louisiana State Board of Medical Examiners, it is the medical board that would enforce the Louisiana anti-kickback law on licensed physicians. So the next slide I want to, that reads across the top, the recent FQHC HIPAA settlement. Even though we told you we're going to just talk about financial relationships and focus on the anti-kickback statute and the Stark law, etc., we felt we could not, not include a commentary on this recent settlement that was announced by the Office of Civil Rights, or the OCR, on April 12th. You may have heard of this settlement. This was involved a FQHC, and I believe they're located in Denver, and this particular FQHC, their settlement, according to the press release by the OCR, was based on the lack of a security management process to safeguard electronic protected health information. Specifically, what happened was a hacker assessed in January 2012 employees' email accounts and obtained 3,200 individuals' electronic protected health information through a phishing incident. The FQHC filed a breach report on January 27, 2012 with the Office for Civil Rights. And on the Office for Civil Rights follow-up investigation, while they did find that the FQHC did take, as they said, concluded necessary corrective action related to the phishing incident, their investigation also revealed that prior that the FQHC did not conduct a risk analysis until mid-February 2012, which was a month after this incident, as required under the HIPAA security rule. And prior to incident, besides not conducting a risk analysis, they said they did not conduct or implement any kind of corresponding risk management plans to address the risks and vulnerabilities that would have been identified in the risk analysis, which apparently the OCR believes they would have prevented this particular incident. What I did find interesting, just want to note that the OCR put in their press release, they did consider their status as a FQHC when balancing the significance of the violation with their ability to maintain sufficient financial standing and provide ongoing care, considering a $400,000 settlement payment by the FQHC. And so, which tells me they found enough where they had decided to drive to this particular amount. So this just highlights the need to have a HIPAA compliance program to make sure you've done a risk analysis and you've taken the issues identified in that risk analysis and put them into a risk management program to at least be in the position to say you've met your obligations, and just want to highlight that. I don't know if, John, you have anything to add or?
Not really on that point, no.
All right. So the next slide, we're going to I want to discuss the federal anti-kickback statute. The federal anti-kickback statute, this is one of the primary federal laws you need to be familiar with and keep in mind in your business operations. The federal anti-kickback statute is makes it a criminal offense to knowingly and willfully offer, pay, solicit, or receive any type of remuneration to induce referrals of items or services reimbursable by a federal health care program. So that's what's important in that line right there is first, remuneration. Remuneration can include the transfer of anything of value, directly or indirectly. So it doesn't have to be cash or any kind of financial remuneration. It can be free rent, can be overpaying for particular services greater than fair market value. It can be anything that really relieves somebody of a financial responsibility for a particular item or service or anything of that type. And this does apply to any type of patients that are covered by a federal health care program. So not just Medicare and Medicaid. It covers TRICARE and other types of federal programs. So the potential penalties for violation of the anti-kickback statute, I want to emphasize there's criminal and civil penalties. So while it makes it a criminal offense to pay or solicit any type of remuneration, there are also civil provisions that has a slightly lower standard, but you can still be assessed civil monetary penalties, or the government can seek those type of penalties under the civil sections of the anti-kickback statute, and you can be imposed a penalty, or they can seek a penalty of up to $25,000 per offense. On the criminal side, imprisonment up to 5 years, and civil monetary penalties I mentioned, besides up to $50,000. You can also potential exclusion, either permanent or permissive. Permanent means you're permanently excluded as being able to be a provider in a federal health care program. Permissive means either for a term of like 3 or 5 years, and you can apply to re-enroll as a provider in the federal health care program. And then the last point, there's also potential False Claims Act liability, which has happened since changes by the Affordable Care Act to our fraud and abuse laws in 2010. The government has been able to take the position based on certain statutory changes and case law that if you violate the anti-kickback statute, any resulting claims from the arrangement or with the other providers, of which they believe it's a kickback, then that makes the claim false, and they would seek False Claims Act liability. So in the next statute I want to mention, with the anti-kickback statute, you may already know there are several safe harbors that are in the statute, as well as regulations that the OIG has adopted. And a safe harbor is basically a section of either the statute or regulation that describes a particular arrangement that if a person or entity meets all of the conditions of the safe harbor, then they will be deemed to not violate the anti-kickback statute and cannot be prosecuted or imposed a fine for that particular arrangement. I just want to mention, in reality, we have found that it is rare that an arrangement meets all the conditions of a safe harbor. Generally, it meets all of them except maybe one or two conditions. And in that case, you still want to structure your particular business arrangement to meet the safe harbor as close as possible, and include a couple of safeguards on the provision that you do not satisfy that generally are recognized by the OIG as making them comfortable with that type of arrangement. On this slide, we've listed 3 common safe harbors that would probably be utilized in your operations. There's the employment safe harbor for any physicians who are employees or healthcare providers. There's a personal services and management contract safe harbor, which would be any kind of professional service agreement or independent contractor arrangement would need to meet this particular safe harbor. And if you have a management contract, a lot of people forget that the anti-kickback concerns can apply to a management arrangement. If somebody manages your center, they're considered to be in a position to generate business for your center, which would be paid for by a federal health care program. So the management contract would need to meet this particular safe harbor. And when I say need to meet, I just want to stress it's voluntary to meet it. It doesn't make an arrangement illegal or illegal remuneration as a result if you don't meet it. However, for some of these, you want to get as close as possible to satisfying that safe harbor. Then the last one I've listed is the office space rental safe harbor. Okay, the next slide, we've listed the requirements to give you an idea to satisfy what would be needed to satisfy, for example, the personal services safe harbor. These are the components. First, you would need a signed writing or written agreement which covers the services provided, and those services need to be reasonable and necessary to accomplish the business purpose of that agreement. If that agreement's for less than full time, you would need to specify the exact schedule and charges or compensation for the provision of those services, and needs to have a minimum of a 1-year term. And then the compensation within the personal services agreement needs to be set in advance and consistent with fair market value, and it does not take into account any business generated between the parties for which payment may be made by federal healthcare programs. Those 3 points on the compensation, that say a lot, and we're going to flesh those out some more, but I just want to comment on the set in advance. Means the formula or the compensation is set before the services are provided by, for example, a physician. In other words, you can't set somebody's hourly rate for like a medical director or another type of physician, and then 3 months into the agreement change the rate. For example, you're paying them an hourly rate as a medical director, a physician, and then up to a cap of, let's say, $2,000 a month. That would make the amount set in advance. and then they come back to you and say, oh, I'm spending a lot more time. I need about $5,000 a month. You generally cannot change that in the course of an agreement unless there are circumstances where you do broaden the scope of the agreement, but generally you do not change that amount because the government's concerned that would look like it's rewarding a referral relationship that is probably also happening at the same time. And the next slide, I transition to the Stark Law. And before I go in there, I just want to mention, while we're going through these slides, we also, we comment on what the government believes in their positions. Doesn't mean we're advocates for the government or believe in that. Just want to tell you from a compliance viewpoint what you should be thinking about and prepare yourself to be in a defensible position to address these types of concerns that may be raised with your operations. So the next statute we're going to talk about is the federal Stark Law. The Stark Law is, I mentioned, is a federal statute, and it prohibits primarily two things. First, it prohibits physicians from referring Medicare and Medicaid patients for certain designated health services to an entity with which the physician or a member of the physician's immediate family has a financial relationship. And so keep in mind, this is only a prohibition for physicians in making referrals, and these are only for Medicare and Medicaid patients. And when it says certain designated health services, there are 11 categories of designated health services listed in the Stark Law. 5 of those categories are identified by CPT codes, for example, radiology services. And those codes are updated once a year by the Centers for Medicare and Medicaid Services and posted on their website. Usually, maybe a few codes may be deleted, maybe some codes are added. But for example, any kind of imaging is always applicable to Stark Law, whether it's X-ray services, CT services, MRI, etc. And then the financial relationship are basically compensation relationships or a investment or ownership interest. So any type of compensation for services, whether it's medical directors, professional services to physicians, would make the Stark Law applicable, or if they have an ownership interest or investment interest in a with a physician. The second part of the prohibition is an entity, for example, a federally qualified health center or a hospital. F is prohibited from presenting or causing or to be presented a bill or claim to anyone for a designated health service furnished as a result of a prohibited referral. So in other words, F, unless an exception applies. So if you have a financial relationship with a physician, you're prohibited from filing a claim to the Medicare and Medicaid programs for any services that are furnished as a result of a referral from that physician, unless the financial relationship you have with that physician meets one of the exceptions to the Stark Law. So, and before I just went to the next statute, but I want to mention there's several types of exceptions. There's exceptions for bona fide employees. Similar to the anti-kickback statute, there's a personal services arrangements exception. There's exceptions for space leases, for equipment leases, and each one has conditions that must be satisfied. And the big thing to know about the Stark Law is this is a strict liability statute, meaning you must meet one of the exceptions. You do not need specific intent to violate the law. It's not required. And so if you don't meet an exception, then you have a financial relationship that prohibits the physician from referring certain patients to you for certain services subject to the Stark Law, as well as you're prohibited from billing for those services. So, for example, you have a physician, you have a medical director arrangement with. That would need to meet the personal services exception to the Stark Law, which would require a written agreement describing the services provided by the medical director, describing the compensation based on fair market value, and it would have to be commercially reasonable. And if you do not have a written agreement that's currently effective, you would not meet an exception to the Stark Law, and any patients or services that that physician refers to your center that are subject to the Stark Law would be prohibited, and you'd be prohibited from billing for those services. So with that good information, hopefully I haven't lost you at this point. The sanctions would include, if you do find in that situation, you do have a requirement to refund any claim payments that you received that were furnished as a result of a situation that you don't have do not meet an exception for that financial relationship. So you do have potential overpayment and refund liability as a sanction. There's potential False Claims Act liability. The government would take a position that those services are false claims. You have potential civil monetary penalties because of the self-referral provisions within the civil monetary penalty law, as well as exclusion from a federal health care program for any knowing violations, as well as potential $15,000 civil monetary penalty. So on the next slide, I've listed some common exceptions to the Stark Law. There's an exception, as I mentioned, for bona fide employment, the personal services exception, and space and rental exception. I'm probably going to skip through these a little bit. The next slide gives the requirements of the bona fide employment exception to the Stark Law. The employment has to be for identifiable services, and similar to the anti-kickback statute, employment safe harbor, the primary requirements for the remuneration or compensation under that arrangement has to be consistent with fair market value, not determined in a manner that takes into account the volume or value of referrals, except for a productivity bonus may be paid in certain situations, and it has to be commercially reasonable even without referrals in the arrangement. The next slide, we've listed the requirements for the personal services exception. One thing I want to mention about this is similar to the personal services safe harbor to the anti-kickback statute. Again, you need a written agreement signed by all the parties that describes all the services furnished by the physician. You need to incorporate, this is different than the anti-kickback safe harbor, you need to incorporate other agreements by a reference or a cross-reference master contract list or describe them. So, for example, if you have a medical director with a physician and you also have a space rental agreement or equipment rental agreement or other type of similar arrangement, they need to be listed in this agreement, or you can reference a mastered list of agreements that you maintain. So I want to highlight the compensation, which is a big part of John's area and what his company does. That compensation needs to be set in advance. It cannot exceed fair market value, and it cannot be determined in a way that takes into account the volume or value of referrals. Something I want to stress right here is the requirement cannot exceed fair market value for those services, and fair market value is not what two people agree is fair for services. There's specific definitions, and we always strongly recommend that you seek advice of a company like John's or a valuation company that can tell you the fair market value range for particular compensation in an arrangement. That way, if your particular contract is ever later scrutinized, you have something that says how you got to the number that you use for compensation, and you can back up your particular arrangement. So the next slide, I just want to mention quickly, one of the new things that was added last year to the Stark Law, actually almost 2 years ago now, was a new exception for recruiting assistance for non-physician practitioners. This particular provision, the CMS specifically included federally qualified health centers, and they said under this exception, hospitals, federally qualified health centers, and rural health clinics may provide payments to physicians to assist them in recruiting and employing primary care non-physician practitioners. I'm not sure how many types of arrangements that you may enter into like that, but I think that's a big recognition outside of a hospital context that other providers like fairly qualified health centers and rural health clinics may assist physicians in recruiting non-physician practitioners, especially with the pending physician shortages across the country. So I just wanted to highlight that, and I've also listed on this slide the types of non-physician practitioners that are described in this exception to the Stark Law. Of course, we have nurse practitioners, but also clinical social workers, clinical psychologists, physician assistants, clinical nurse specialists, and nurse midwives. So the next statute, I just did a quick comparison of the Stark Law and anti-kickback statute. We thought this would be useful because it shows first who regulates or enforces each. The Stark Law is enforced by the Centers for Medicare and Medicaid Services, CMS, whereas the anti-kickback statute is enforced by the OIG. Stark Law is targeted on financial relationships, while the anti-kickback statute targets any type of payments intended to induce or reward referrals. The Stark Law is a civil statute only, whereas anti-kickbacks criminal and civil. And the Stark Law, as I said earlier, is a strict liability statute, so you must meet an exception, otherwise you violate the statute, and it only applies to referrals by physicians. Whereas on the anti-kickback statute, they will look, I have to establish intent if they're looking at it from a criminal perspective, or a civil perspective is a lower standard. And it's much broader, applies to any attempts, anyone who attempts, gives, or solicits a kickback and has voluntary safe harbors.
Hi, we have a question on the previous slide about referrals. How are nurses, LPNs, and RNs handled? I think back one more slide.
I'm sorry, Doreen, can you say the question again?
How are nurses, LPNs, and RNs handled regarding referrals?
Okay. If anyone heard the question, what about referrals by LPNs and RNs? Those types of referrals are attributed to the physician that the LPN or RN is working for. So I would consider that it's subject to the Stark Law, and it will be say generally considered a physician referral.
Okay, thank you.
Okay, I'm now on the slide that says the False Claims Act across the top. And the False Claims Act, there's a Civil False Claims Act and a Criminal False Claims Act. They're federal statutes. The important thing for you to know that is the False Claims Act. It prohibits the knowing submission of false claims or the use of a false record or statement for payment with government funds. It covers claims presented to any federal health care program. And the last point is the term knowing in the False Claims Act includes, besides actual knowledge, any type of deliberate ignorance and reckless disregard for the truth or falsity of the information. So before we talk, I'm on the slide on the False Claims Act penalties. Before I go through this slide, I want to mention I did see a press release in August 14th of 2015 by the Western District of Oklahoma, the United States Attorney's Office there. May be of interest. It says a Oklahoma federally qualified health center agreed to pay $825,000 to settle allegations of submitting false Medicaid claims for medical services. Fortunately and unfortunately, this is an example where the False Claims Act would come into play with a fairly qualified health center. Here they, they had provided primary health services to specific medically unnecessary underserved population, and they also provided behavioral health and dental services, and the allegations were that they were not medically necessary services that were provided, and the payment arrangement, the U.S. Attorney's Office felt they violated the False Claims Act and the claims they had submitted, and that was the resulting settlement. So I mentioned the name of the center, in case you want to look it up, is the East Central Family Health Center, and it was August 14, 2015. So with that exciting information, we'll talk about the False Claims Act penalties. The penalties have recently been increased, so you can be assessed monetary penalties of $10,781 up to $21,563 per claim, plus 3 times the damages obtained by the government, which would be their damages they allege are the amount of the false claims. So if you have $100,000 in false claims, they can seek $300,000. And you also face possible exclusion from participation in the federal health care program, as well as could be subject to criminal penalties for submitting false claims. So now we get to the exciting part, even though that all was exciting on identifying financial relationships. Quick comment under the Stark Law to remember, you want a financial relationship with the physician would trigger the Stark Law, and that would generally be a compensation arrangement or an ownership or investment interest. And under the anti-kickback statute, you would have concerns of any type of remuneration to a referral source or someone who could generate business for you. So it doesn't have to be a licensed healthcare provider. It can be somebody like a management company or any type of arrangement. The next slide says identifying financial contractual relationships. We took this from a recent OIG corporate integrity agreement that they entered into with a provider as a result of a settlement, and it was a settlement based on certain violations of the Stark Law and the anti-kickback statute, and they required the provider to focus on types of arrangements they call focus arrangements, and we thought that would be useful to you to see how they define that in case you're looking for a way to define the types of arrangements that you need to inventory and track in your compliance program. The next slide are examples of financial relationships. We've talked about employment agreements, professional service agreements, or medical director agreements, space and equipment leases, management agreements, and staffing agreements. I don't know, John, if you had any other examples.
Yeah, Clay, thanks. Excuse me. I think the 3 most applicable to FQHCs are the first 3. Employment agreements, which are self-explanatory. Professional services agreements would involve an arrangement where the FQHC might contract with an independent physician, to provide services you know, X hours per week or X days per week, and then the medical directorship arrangements. And let me just comment on those three specifically. With regard to the employment agreements, which is what most FQHCs have with their providers, the important part is to make sure that the compensation is within fair market value. Now, if you have existing physicians or nurse practitioners that have practiced for a while and their agreements are coming up for renewal, you have to look at their compensation versus their level of production. And the level of production would either be patient encounters / visits or work RVUs, but in most cases, FQHCs use visits, you know, as the benchmark for productivity. And also, depending on your geographic location, you have to be cautious not to exceed fair market. And fair market value, as a rule, notwithstanding their productivity measures, as a rule, the compensation would be at the 75th percentile based on national data. And you know, we do fair market value opinions every single day somewhere in the United States. The only time you can exceed the 75th percentile is if you are located within a health professional shortage area or a medically underserved area. And in those cases, you can safely go to the 90th percentile. But nonetheless, you know, it's strongly encouraged that you have someone evaluate your employment agreements, certainly before they're signed and even as they're renewed, make sure you're within fair market. Now, some of you also have not only employment agreements that have base compensation, but also incentive compensation. And that can take one of two forms. Usually the incentive compensation is based on production, i.e. the number of visits. So if a provider exceeds a certain number of visits, they get X dollars per visit for those visits that are exceeded. There are some who use work relative value units, but that's pretty uncommon in FQHCs. Most of the time, incentive comp is based upon visits. Now, there are some that use quality measures, and that's a kind of a separate discussion. So most folks use quantitative measures, although there are more and more using qualitative measures because of, you know, how many quality measures FQHCs have to report. And then the only other comment would be on medical directorship arrangements, just to make sure that whomever is the medical director has to submit monthly timesheets in order to document their activities. And what we often find is the medical director is given $2,000 a month, period. Well, you really can't do that. It's recommended that they be compensated on an hourly basis, and at the end of the month, they have to submit a timesheet documenting the activities in which they participated, and then they're paid, you know, X hours times Y per hour. And that's often a problematic area where a physician is just given a flat amount of money to be a medical director and may not satisfy the number of hours required in each month. So those would be my comments on these types of financial relationships.
Good, John. And I'd like to follow up on your comments on the medical director agreements. That is a huge area of focus, or has been an area of focus, and an area in which there have been a lot of settlements under the fraud statutes and fines imposed on healthcare providers based on medical director arrangements. And the next slide has references I'll just click over that real quick, a special fraud alert released by the OIG in June of 2015 regarding compensation arrangements with medical directors, where they emphasize it has to be fair market value for bona fide services that physicians actually provide. And that kind of encompasses a lot of what you said. I strongly recommend an hourly rate up to a monthly cap of like $2,000, and also to have some kind of valuation opinion or letter that shows how the hourly rate was established, and most importantly, have the medical director complete a timesheet and turn in prior to getting paid, which shows that they spent a half hour here, an hour there. So you have defensible records that they perform the services which are administrative only under the agreement in case the arrangement is looked at. There are a lot of abusive situations where it's just $2,000, a flat amount. The check is automatically being paid to the medical director. You can't really establish what they're performing, and they may or may not be performing any services. So this slide also has questions common questions that get asked in scrutinizing a medical director or other type of professional service agreement. How are they selected? What is communicated about how they're selected? In other words, because we know you're a big, our relationship with you and your patients and so forth, how's the performance tracked, and are they paid regardless of the services? So I would like to, because of the time we have, let's see, the next slide addresses some common issues. And that was the fair market value, commercial reasonableness. John, you may want to go into a couple of those if you want to do that.
Yeah, the fair market value we briefly discussed before. You know, commercially reasonable. The basic definition is, in the absence of referrals, what would a reasonable business person do? That's kind of the benchmark against which you have to look at your agreement. So, you know, for example, would a reasonable business person, you know, pay $100,000 a year for a medical director in the absence of referrals? Well, the answer is no. Now, if you're expecting referrals in exchange for $100,000, you'll need to call Clay because you got a problem. But back to the medical director issue real quickly. You know, we rarely see that in FQHCs. We occasionally see it with hospitals, but it seems that, and correct me if I'm wrong, Clay, but the main problem we see with excessive medical directorship agreements is within psychiatric hospitals.
Yes, it's the compensation amount with those type of agreements, and then the commercial reasonableness factor really comes in of how many medical director agreements do they have. In other words, if they have 4, do they really need a 5th, 6th, and 7th one, and the services overlap? That's when the red flag will really go up.
Yeah, and I think maybe the caution for FQHCs, here again, depending upon the size and scope of the operation, you know, the first question would be, well, how many medical directorship agreements do you need? Now, you know, if you have different departments, like you have obviously pediatrics, family practice, whatever, there may be a need for more than one medical directorship arrangement. However, you have to make sure that they don't have overlapping responsibilities. And as Clay mentioned before, the services have to be extremely well defined and documented monthly through a timesheet, and that's how they're paid. So the caution is, please don't give them a flat amount per month and not require them to submit timesheets, because then you're going to have a problem.
Yep. And then same thing may go, I don't know how common it is to have equipment leases or medical office space leases, either to or from physicians or referral sources. But if you do, verify that the purposes of that agreement, are you using that space, or do you need that equipment, and document that as you go along in case that gets questioned. There have been several recent settlements on that.
Yeah, I think the only caution there, say on the space lease, you know, if an FQHC was going to lease space to a specialist, you know, to come one day every 2 weeks or one day a month or whatever, you have to make sure that the lease you're charging that specialist is commercially reasonable. And you just go through the calculations, you know, as far as, you know, the amount per square footage, and you break it down by day or whatever. So you can't just say, well, you know, doc will charge you $100 a month to occupy this space, you know, one day every week. Well, that's not commercially reasonable. So again, that's just a caution on those sublease type of arrangements.
Right. And I like how you say it's a caution, but if you go to the OIG site, you'll see a lot of settlement under monthly under the civil monetary penalties law on that same issue. So I'm going to, because of the time, I'm going to skip the historic law fair market value discussion and go to the fair market value discussion on 501c3 organizations.
Yeah. Let me comment on that real quickly. Yeah, and then we can take some questions. The issue here is if you excessively compensate physicians, a couple of bad things can happen. Number one, it may jeopardize your 501c3 status. But secondly, if it's deemed by the IRS that you've excessively compensated a physician, both the CEO of the FQHC, the CFO of the FQHC, and the physician face personal excise tax of 30% of the excess compensation. So, for example, if the fair market value was $200,000, and you chose to compensate Dr. Smith at $300,000, well, if the IRS finds that out, that would be $100,000 over the fair market, which means they're going to send a bill to the CEO, the CFO, and the physician for $30,000 of fees. Okay, that's the caution. So not only might you jeopardize your 501c3 status, but you personally, as well as the physicians, can face an excise tax penalty.
So it doesn't sound like somewhere you want to be.
I'm not sure we've given a lot of good news today, but hopefully,
right.
hopefully it's helpful information.
Yeah. I'm going to skip through the next couple of slides since we've talked about it some, and we've got historic law commercial reasonableness, a couple of settlements that emphasize fair market value and potentials for paying more than fair market value with physicians. And we'll stop here on a couple of compliance strategies in the next two slides. First on governance. We want to emphasize and having an approval process for agreements. We have involvement and oversight by your board or board committee, which I think many FQHCs do have, but make sure you include in that reviewing agreements and renewing agreements. We recommend periodic reporting on contractual agreements or arrangements. And then the next statute slide talks about internal review and tracking process. And we took these recommendations straight from an OIG corporate integrity agreement, which would highly recommend that you consider having a centralized tracking system. You track remuneration to and from the parties. You monitor the use of the space or supplies or medical devices if it's applicable. Have a review and approval process. You have an appointed compliance officer who would review the arrangements, and you implement any responses of potential violations or, let's say, non-compliance. So with that brings us to the last slide on questions. Doreen, are you aware of anyone have any questions, or does anyone have any particular areas they would like to hear more about?
I don't see any at this time. If anyone has a question, please enter it into the chat box or raise your hand and I can unmute you.
Well, we're waiting to hear some questions. I would just emphasize, because of the aggressive enforcement environment, just want to give another recommendation to having a system to maintain and track all your agreements that you feel would apply, have the Stark Law and a kickback statute or any other particular fraud statute apply to that, and have that organized to make sure you have a written agreement, you have a basis for the compensation, and those services are being provided to put you in that particular position, to be defensible in case they are scrutinized.
I haven't seen any questions come in, so we can just end here for today.
Well, thank you, Doreen.
All right, thank you, Doreen. Thank you, John.
Thank you, Clay.
Thank you so much for presenting, and we'll be sure to upload the webinar onto the website soon. Thanks.
Fair enough.
Thank you.
Thank you. Bye.
Bye-bye.